You're standing at the pump, watching the numbers climb. 310, 320, 330. You pull the nozzle out, twist the cap, and before you even get back in the car, you do what you always do. You check crude oil prices on your phone. And there it is, $68 a barrel. You squint at the screen. You remember 2018. You remember $68 a barrel. You remember $2.50 a gallon. You're looking at the same commodity input, the same barrel of oil coming out of the same ground, priced the same way it was priced 7 years ago. And somehow you're paying 80 cents more per gallon. Every single fill-up, every single week. That 80 cents has a name, it has a paper trail, and it has a destination. A federal investigation found it. Let me show you where it goes. Let's start with what a gallon of gas actually is, because most of us treat it like one thing. You pull up, you pay, you leave. One transaction. But that gallon has 4 layers baked into the price, and the Energy Information Administration, the federal agency that tracks every drop of petroleum in this country, publishes the breakdown. Here's what a gallon looked like in 2018 when you were paying about $2.55. Crude oil cost, $1.38. That's the raw material, roughly 54% of what you paid. Refining costs and margin, 33 cents, about 13%. Distribution and marketing, 31 cents, 12%. Federal and state taxes, 54 cents, 21%. Now here's the same gallon in late 2024 at $3.30. Crude oil cost, $1.42. Refining costs and margin, 69 cents. Distribution and marketing, 50 cents. Taxes, 69 cents. Look at the first number, the crude oil. $1.38 in 2018, $1.42 now. That's a 4-cent difference, 4 cents. The raw material barely moved. Now look at taxes. They went up about 15 cents, mostly because a handful of states, California, Illinois, Ohio, raised their fuel taxes between 2019 and 2023. The federal excise tax on gasoline has been 18.4 cents per gallon since 1993. It hasn't changed in over 30 years. So taxes explain maybe a dime of your 80-cent gap. 10%. That leaves refining and distribution. Combined, those two layers went from 64 cents per gallon in 2018 to $1.19 in 2024. That is where your money went. 55 cents of your 80-cent gap is sitting in the space between the crude oil coming out of the ground and the gasoline going into your car. Not in taxes, not in the commodity, in the margin that the people who process and move the fuel decided to take and keep. There's an industry term for the refining piece. They call it the crack spread. The 3-2-1 crack spread, specifically 3 barrels of crude oil in, 2 barrels of gasoline, and 1 barrel of distillate out. It measures how much more the finished products sell for than the crude oil they came from. It is, in plain language, the refiner's markup. And here's the chart you need to see in your mind. Between 2015 and 2019, the crack spread averaged roughly $14 to $18 per barrel. That was normal. That was the range that kept refineries running, kept gas around $2.50 when crude was in the 60s, and kept the system roughly in balance. In 2020, it dropped below 10 during the pandemic. Demand collapsed. Nobody was driving. In 2021, it climbed to 20, 25, as demand came roaring back faster than supply could adjust. And then in June 2022, it spiked above $60 per barrel, the highest level ever recorded. 60. There were real reasons for that spike. Post-pandemic demand hit a refining system that had lost capacity. Global energy trade got disrupted. Everything tightened at once. The crisis was real. Nobody disputes that. But here's what happened next. The crisis ended. Crude came back down. Demand stabilized. And the crack spread settled into a new range, $25 to $35 per barrel. Roughly double the 2015 to 2019 average. It went up like a rocket. It came down like a feather. And then the feather stopped falling. Economists have actually studied this pattern for decades. Borenstein, Cameron, and Gilbert published the foundational paper in the Quarterly Journal of Economics in 1997. Gasoline prices rise fast when crude goes up and fall slowly when crude comes down. The Federal Reserve Bank of Dallas confirmed in 2022 that the asymmetry is still present and actually stronger in markets with fewer competing stations. The industry term is rocket and feather. Why? What makes the post-2022 pattern different from a normal feather is that the adjustment downward appears to have stopped permanently. The feather hit a shelf and stayed there, and there is a structural reason it stayed. Between 2019 and 2023, the United States lost approximately 1.1 million barrels per day of refining capacity. The EIA administrator testified to this number before Congress. Let me walk you through what that looks like. Philadelphia Energy Solutions, the largest refinery on the East Coast, 335,000 barrels per day. Explosion and fire in June 2019, permanently closed. Marathon Petroleum's Martinez, California refinery, 161,000 barrels per day, converted to a renewable diesel facility in 2020. Phillips 66's Alliance refinery in Louisiana, 255,000 barrels per day, permanently shut after assessing Hurricane Ida damage in 2022. LyondellBasell's Houston refinery, 263,000 barrels per day, closed in 2024. Every one of those is gone. Not idled, not on maintenance. Gone. And here is the fact that makes the gap permanent until something structurally changes. No major new refinery has been built in the United States since Marathon's Garyville expansion completed in 2009. That's 16 years without a new refinery coming online. Existing facilities have done some debottlenecking, small expansions around the edges, but net capacity has declined. Less capacity, similar demand. Remaining refineries running above 90% utilization, and margins that nobody has any structural incentive to bring back down. You want to know what makes this different from a conspiracy theory? The companies told you, on the record, in public filings with the Securities and Exchange Commission. Marathon Petroleum's CEO discussed what he called capital discipline on an earnings call in 2022, the strategic decision to prioritize shareholder returns over volume growth. Capital discipline. It's a Wall Street term. What it means at the pump is straightforward. We could invest in more capacity, produce more gasoline, and prices would come down. But our shareholders prefer the margins. So we're keeping production where it is. This wasn't whispered in a back room. It was stated in a quarterly earnings call that anyone can read in the SEC archives. And they were not the only ones. The FTC's September 2023 report documented that the four largest U.S. refining companies, Marathon Petroleum, Valero Energy, Phillips 66, and PBF Energy, collectively increased their net refining margins per gallon significantly during 2021 and 2022, and maintained those elevated margins into 2023. The FTC used the company's own investor communications as evidence, their own words, their own strategy. The report's language was specific. Some oil companies weighed profits over output. The FTC chair stated it plainly when the report was released. The largest oil companies used the cover of a global crisis to pad their margins. Now, I want to be precise here, because precision matters. The FTC did not find illegal collusion. They did not say these companies got in a room and agreed to keep prices high. What they documented was parallel behavior, companies independently arriving at the same strategy of restraining capital investment and maintaining elevated margins, partly because their investors were demanding better returns after years of low returns in the 2015 to 2019 period. That distinction matters legally, but economically, for you, standing at the pump, the result is identical. Whether 4 companies coordinated or 4 companies independently decided to do the same thing because the same investors pressured them all toward the same strategy, your gallon costs 80 cents more either way. Congress held hearings. The Senate Commerce Committee brought in executives. Industry representatives testified that the gap was about regulatory costs, biofuel blending mandates, environmental compliance, maintenance expenses. And those costs are real. They're not zero, but the magnitude doesn't match. Operational costs did not double between 2018 and 2024. The crack spread did. Let me show you this layer you probably haven't thought about. Everyone focuses on refineries and crude oil, but the distribution and marketing layer, pipeline transport, terminal storage, the wholesale price at which fuel leaves terminals, and the retail markup also expanded. Wholesale to retail markups averaged 15 to 20 cents per gallon nationally in 2018. By 2023 and 2024, they'd widened to 25 to 35 cents. Some of that reflects real cost increases. Labor at stations went up. Credit card processing fees are percentage-based, so they rise automatically when the price of gas rises. Some reflects consolidation in the convenience store and fuel station industry. But here's the thing, almost nobody realizes. Your local gas station is probably not the one making money on this. Retail fuel margins are the thinnest layer of the entire supply chain. The National Association of Convenience Stores, the industry's own trade group, has documented this repeatedly. Most independent stations earn 5 to 15 cents per gallon on fuel. They make their real money on the coffee, the snacks, the energy drinks you grab on the way out. The person behind the counter at your corner gas station is not pocketing your 80 cents. The margin expansion lives upstream, at the refinery level, at the wholesale distribution level, in the hands of 4 companies whose earnings calls you can read for yourself. Let me make this personal, because that's where it actually lives. The average American household consumed approximately 1,120 gallons of gasoline per year, according to the Bureau of Labor Statistics Consumer Expenditure Survey. At 80 cents above what the crude oil price historically implies, that's $896 per year. Call it $900, $75 a month. That's roughly a month's worth of groceries for a single adult, or a year's worth of streaming subscriptions, or the difference between contributing to your retirement account and not. $75 a month, every month, leaving your household budget and entering the refining and distribution supply chain as expanded margin for a crisis that ended 3 years ago. Scale it up nationally, and the number gets staggering. Americans consume roughly 369 million gallons of finished motor gasoline per day. At 80 cents per gallon of margin expansion, that's $295 million per day, transferring from consumers to the supply chain. Over a year, that's approximately $108 billion. That is not a rounding error. That is one of the largest sustained cost increases in American household budgets that has nothing to do with the price of the underlying commodity. You feel this. You feel it every time you fill up and the total seems wrong for what crude oil is doing. You feel it when you remember what you used to pay and do the mental math, and it doesn't add up. You feel it when your grocery run costs more and your commute costs more and your take-home stays the same. and you start quietly cutting things from the budget you didn't think you'd have to cut. The extra dance class for your kid, the weekend trip you used to take without thinking, the restaurant meal that used to feel normal and now feels like an indulgence. That erosion is real. It's not inflation in the traditional sense. The crude oil input is the same price. It's margin expansion baked into a supply chain that lost enough capacity to maintain pricing power and whose operators explicitly decided, on the record, in SEC filings, to maintain that pricing power rather than invest in new capacity that would bring your price down. If you've been filling up twice a month and wondering why it still stings, even though you keep hearing crude oil is down, here's your answer. It's down. Your price isn't. And the distance between those two facts has a name, a documented mechanism, and a set of companies whose own earnings calls explain exactly why it persists. Now, there's a genuine debate among energy economists about whether this represents a market failure or a rational repricing. Severin Borenstein at UC Berkeley's Energy Institute has argued that the combination of refining consolidation, capacity reduction, and parallel capital discipline strategies amounts to an oligopolistic outcome. A market that is not functioning competitively when margins can double and persist for years without new competitors entering to bring them down. On the other side, industry analysts argue that pre-2020 refining margins were unsustainably low. Refineries were earning below their cost of capital, which is precisely why some of them closed. The current margins, in this view, reflect the true cost of running a refinery under modern environmental, labor, and regulatory conditions. If margins were genuinely excessive, the argument goes, new investment would flow in. Both sides have a point. And here's what I think is the honest synthesis. The pre-2020 margins probably were too low for the refining industry to sustain itself long-term. Some correction was justified. But the correction overshot, and the structural conditions, consolidation, no new builds, investor pressure for capital discipline, mean there's no market mechanism to bring it back. The gap is real. The gap is documented. The gap is not going away because the refineries that closed are not reopening, and the refineries that remain have no incentive to expand. Mark Finley at Rice University's Baker Institute put it simply. The refining sector went from having too much capacity to not enough, and the adjustment was permanent. If you're waiting for gas to go back to $2.50 at $68 crude, let me be direct with you. It's not coming back. Not because of taxes, not because of some policy, not because of the party you didn't vote for. It's not coming back because the physical infrastructure that made $2.50 possible at $68 crude no longer exists. The refineries closed. No one is building new ones, and the companies operating the remaining ones have stated publicly that they are prioritizing margins over volume. The crisis premium became permanent because the structural conditions that created it became permanent. Understanding this won't lower your gas price next Tuesday. I wish it did. But it changes what you see when you look at that sign. It's not some abstract force making gas expensive. It's not crude oil. Crude is where it was 7 years ago. It's not your state taxes. Those explain maybe a dime of it. It's a supply chain that lost capacity, found it could charge more with less competition, and decided to keep charging more because its shareholders rewarded the strategy. If you've been looking at your monthly budget, wondering where the squeeze is coming from, your income is the same, your expenses keep climbing, and you can't quite find the line item that explains all of it. This is one of those line items. $75 a month, every month, for a crisis that ended in 2023. You're not imagining it. The math is the math. A federal investigation documented it. Congressional hearings examined it. The company's own earnings calls explained the strategy behind it. And the crack spread is still sitting at double its historical average as of this morning. That's not a cycle. That's a new price. The next time you're at the pump, watching the numbers climb past $3 and doing the mental math against what crude is trading at, you'll know exactly where the gap lives. Not in the ground, not in the tax code, in the space between the barrel and your tank, where 4 companies decided the crisis was too profitable to let go of. A federal agency put it in a report. Congress held hearings about it. The executives testified. The crack spread is still elevated. You can't negotiate with a supply chain. But you can stop wondering if you're crazy for thinking the numbers don't add up. They don't add up. You were right. Now you know exactly where the 80 cents goes. If this is the kind of math you want done honestly, no products to sell you, no portfolio to pitch, no party to blame, subscribe. I'll keep running the numbers. Tell me in the comments, when did you first notice the gap between what crude oil was doing and what you were paying? Because I'd bet anything it was before anyone in a suit admitted it was real.